Yes, time frame's a good question, and it's something that, in terms of my strategy, I've come and found my own truth. As I trade with a trend, I don't look to pick reversals, because often reversals have a lower success rate and they don't turn out to be reversals. In other words, going back to that Isaac Newton and that Einstein type philosophies, things continue to move generally. In other words, they're moving for a reason. So on basis, I trade continuous patterns. So I have a trend time view. I then have a pattern view where I'm looking at the setup as it is the squeezing of the volatility. It stopped going up for a while, it's resting. And then I have what I call a trigger time frame, which will be the time frame whereby you're actually looking at the specifics of the market to get your unique high 3 point and when the breakout is going to happen. So that is very focused on timing. So one is, which direction is the river flowing? Is it flowing, where is south, downstream? Get that right. That's your macro time frame. So typically, the best time patterns are taken on the larger time frame. They're more consistent broadly. You're less likely to be flicked out, particularly if you're in Forex. A variety of other underlying markets can be a bit choppy at times. So I would say you want a trend time frame, which is maybe a daily chart, can even be weekly or monthly, to H4, 4 hours. Your pattern time frame, where you're looking specifically at the setup and identifying the aspects of it. So if I'm talking about a symmetrical triangle, your 3 highs, your 3 lows, the pinch, that would be 1/4 thereof. So if you're on a daily on your trend time frame, I would be on my pattern view 4 hourly. And then when I'm looking at just that third high and that third low and the move that takes it through the high 3 that reasserts the bull trend, that would be my trigger and timing time frame. I want to really pick that third high and get that stop neatly nailed, and the point at which I enter with a pending order. Note also, it's a pending order. In other words, the market must take you in. This actually eliminates a lot of bad calls. In other words, if it breaks down and is a reversal instead, you don't get taken in. Most people are getting in on market orders because they say, oh, I must be in. The market's moving, and they jump. They're momentum chasers by our default, because you want to be excited. It's going up. You want to be part of it. You chase the train. And so a pending order is more about a price level falling than a specific moment in time that you want to be in the market. So that trigger time frame would be 1/4 of the 4 hourly. So you would have a daily trend, you would have 4 hourly pattern, and you would have 1 hour for capturing that final third high and third low, which represent the breakout and the stop loss placement. Bang, those are my 3 time frames. So I'm actually looking at 3. The first one, once you've got that right, it's nailed, you can set aside. Then you concentrate on the other 2.